Despite a tough financial year punctuated by COVID-19 and the declining economy, NSSF delivered at their annual members meeting an impressive 12.15 interest rate for savers. The rate ushers in a long-held debate in Parliament on midterm access. Should savers get some of their money? Tonight my guest is Mr. Richard Byarugaba, MD of NSSF. Mr. Richard Byarugaba, thank you so much for having honored our invitation. The spotlight is on you. A warm welcome.
Thank you so much for having me tonight. A rather short notice as well. It was all going well yesterday after we announced our rate at 12.15%. And this morning there was a screaming headline in your paper, actually not yours, but your group's paper, that the savings were going to be taxed.
Okay, we'll get into that. Before we even reach the saving, want to know what savings do we have. What is the financial strength of the fund in which you are the MD? Well, the financial statements that we used to announce the rate of 12.15 show that our assets under management, these are the things that are under our control on behalf of our members, is about 15.6 trillion shillings. That's colossal sums of money, huh?
It is, but our members own 15.3 trillion shillings of that. So there's a difference of about 300 billion, which is in other assets which do not have any liabilities attached to them.
I'm here seated with a gentleman who's managing a fund worth 15 trillion Uganda shillings. That's a big deal.
Big deal. It is about, would you believe it, it's about 10% or slightly more than 10% of Uganda's GDP.
That's even a serious deal now.
Yes, absolutely. So, yeah, and we don't take that for granted. It's an opportunity to serve our members. It's an opportunity to give them value. Obviously, they have their life savings. One of the researches we've done show that at least 90% of our members don't have any other form of savings apart from NSSF.
This is all they have?
So that's all they have. So these are life savings, and therefore...
You've been at the helm of NSSF for quite some time now, maybe a decade or 10 years, if I can remember well. So how has it been, what has the curve, the trajectory been like?
Okay, so when I joined the fund, we were managing about 1.5 trillion shillings in assets under management. We were the smallest fund in East Africa. So we've grown by about 10 times over this period. An impressive performance. We are now the largest fund in East and Central Africa. And we continue to provide the largest return to our members, certainly within the region. And if you look at all the other economic indicators, all the efficiency indicators, we've done very, very well. If I were to plot a graph, if you look at the growth of the fund from the time the fund was created in the 80s, early 80s, and you then look at how it had grown from zero in the 80s to 1.5, 1.6 trillion in 2010, you'll see a flat curve, all right? And then suddenly after 2010, you've got an exponential growth, which is exactly what has happened during these last 10 years. You're
now giving us 12.15 interest rate, which is a good thing because over and above the inflation rate. But there was a time when NSSF was giving 15%. What happened?
I think that was a one-off.
Why should it be a one-off? It's supposed to be consistent.
No, I think you need to understand where we invest, why we invest, the philosophy around the investment. Every person who makes a decision to invest is looking at two things. One, what is the return that is available to the member? But two, how much risk am I exposed to? And the usual thing that happens in life is the more risk you take on, the higher the return, but also the higher the risk that you might not meet your target. So one of the indicators that is used is what they call the standard deviation, which is really a measure of risk to a portfolio. So the higher the risk, the higher the return. But because, as I started off by telling you, that these are savings of individuals, they are life savings, many people don't have any other savings, this is their only savings in life, and therefore we cannot afford to lose these ones.
As you grow into the business, you're less risky than you're taking you're not taking risks like you used to.
No, I don't think that's the thing. We've got a strategic asset allocation, which is a fancy word of saying how much assets can we put in one class, how much can we put in another class, and how much can we put in another class. So we invest in 3 asset classes. I like to talk about them. The first asset class where we have the majority of our investment is in what you'd call fixed income investments. These are traditionally things like fixed deposits, things like treasury bills, things like treasury bonds, things like corporate bonds. So these are investments where you know that the return is determined before the investment is made. So if you buy a bond that is paying out a coupon rate of 14%, you know that over the period of the... You'll have 14%.
Where else is our money invested?
The other place where we invest our money is in equities. We invest in both public and private equity. So public equity are those equities that are listed on the stock exchange. So if you were looking at an investment such as Stanbic Bank, an investment such as Umeme, those are public investments, and you go and you buy the shares, and you know that you'll get two bits of things from there, 2 returns. One is obviously the dividend that you're paid every year when the company makes money, and the other one is the capital gains. In other words, you buy the share at 10 shillings, and the following day it is worth 13 shillings. You've made 3 shillings as a capital gain.
So you buy the shares and think that the business is going to run smoothly, will be better, and so that you can make money, because it's not in your hands. You just risk it there.
Absolutely.
And considering that now businesses are folding and leaving, there are many, especially the retail shops and all this kind of stuff, including the other day we saw British Airways leave and Barclays Bank now leave and stuff like that. Doesn't that scare you that even some places you have chosen where to invest, probably things could backfire?
Oh yes, there is no doubt that equity investments can be risky, because, as you said, you are depending on the management team and the board of the company to make sure that they do the right thing to continue to provide you with a good return on your investment. Certainly there is a risk, and that's the inherent risk that is in the stocks. Of course, the other class that I should talk about is the real estate asset class, which is our least, it's the smallest exposure for us. So just to summarize, so that we can finish the whole issue around where we invest, we've got about 78% exposure into the fixed income space. We've got about 15% exposure into the equity space, and about 7% exposure within the asset class of real estate. As you can see,
why did you choose to put something small in real estate? Because that's an area where Ugandans, we lack a lot. And you have 15 trillion.
A lot, but we have
15 trillion. You can just go into a housing project, and that could bring you money, I suppose.
Yes, it does bring us money, but real estate is one of the asset classes that have the highest amount of risk for investment. Let me tell you why. In what
sense?
Well, because the returns, for example, this year, okay, just this year, I can tell you that we earned around 16% in our fixed income portfolio. We earned 19% in our equity portfolio, but we earned only 8% on our real estate portfolio, all right? So the returns in real estate can be very high in very good years and can be very low in very bad years.
What explains that?
It's the cycle of the economy. During the boom times, the returns are very good. There's a lot of expenditure. People are buying houses. Everybody has got a disposable income. They are investing in housing. They are going into housing. They are acquiring property. So they are renting property. They are So all the things, activities during boom times tend to be very good in real estate. However, the challenge is that during boom times, that's the time when also other developers get an interest in trying to visit to do more housing. What then happens is the next thing that happens is a downturn. So when a downturn comes, guess what? There is less demand, there is less disposable income, and suddenly there is a glut in the property market, and suddenly you've got a bust situation, right? So if you look at all the economic crises in the world, they tend to be around real estate. I'm sure you
including the 208.
208,
yeah.
The Dubai crisis for property, the China crisis for property. Those are the ones that are big. But if you look at many markets, they all go through their boom and busts. We did go through a boom and bust property market not so long ago in this particular market. I'm sure you know that at one stage, 1 acre of land in Kololo, upscale Kololo, was selling for $3, $4, $5 million. But today, I'm sure you know that you would really struggle to get $1 million, maybe $1 million and a bit for an acre of land in Kololo. So it definitely is one of these asset classes that go through really big swings in terms of returns.
Even when a country like ours has a deficit of housing?
I can actually tell you that the deficit of housing here is almost 2.5 million units, growing at about 200,000 units a year.
Then this should be a virgin market.
But guess what? It is affordability. The average house on the market the average affordable house on the market is not less than 300 million shillings. That is not affordable. The challenge, as we've already said in this country, in real estate really lies around two main areas. The first is land. The price of land is very, very erratic. It is determined by a lot of speculation. A lot of people buy land just to sit on it and take advantage of a situation that. And
some people buy land just to clean their money because it's ill-gotten.
Well, I didn't want to say that.
Right.
The second issue, the second big issue is around infrastructure. You know that there are very few parts in Kampala where you will find the roads have been done, the electricity has been done, the sewage has been done, and all the other infrastructure that you normally require for a home. So most developers tend to then have to price their houses with the land. They tend to price their houses with the infrastructure that they've been able to build, and by the time that is added on to the value of the property, it is no longer affordable.
Because what matters?
Unless, of course, you want to do the rentals in low-income areas, which
may not have the infrastructure.
Yeah, which may not have the infrastructure, and those turn out not to be really decent places, and you end up with slums. Which are not desirable.
And whoever needs a house, I suppose it's location that matters.
Absolutely, and I wouldn't play in that sort of market. We definitely wouldn't want to build, a 10 million room, which you might be able to sell. But I'm not too sure would like to play in that market because, again, would have to put in the right infrastructure and so on and so forth. And of course, we've got our inherent challenge as NSSF in the sense that every single time we are looking for land, NSSF then tends to be, we are priced a premium because we are NSSF.
All right, the elephant in the room, the midterm access.
Yes.
And I know some people who were skeptical, including yourself at the beginning, that Ugandans should not access their money at the age of 40. And
45.
At the age of 45. But now it seems you have evolved a little bit, and you think it's okay. Tell me about the evolution and why earlier you were so opposed to this.
All right, so if you look at the bill that was sent to the president, okay, let's start from the beginning. There was a bill that was drafted and sent to Parliament for discussion.
Yeah.
In there, there was no clause for midterm access for mandatory contributions. There was a clause in there for midterm access for voluntary contributions.
Okay.
What does that mean? That means that if you have saved over and above the 15%, then that balance that you've saved voluntarily over and above the 15% you would then qualify to get a midterm access to it. That's what went into Parliament.
voluntary.
Yeah, voluntary savings.
Yes.
However, when it got to Parliament, two things happened. One, the mood changed in the world. COVID struck, okay? So there was hardship that came around. Secondly, in Parliament itself, there was a lot of people who basically received petitions from their constituents telling them that, look, during this period, I believe that if somebody has saved sufficient money, please help us. Let's get some money.
Go through the tough times.
Yeah, let's go through the tough times. So Parliament, in their wisdom, sat, looked at the requests that had come in through memorandum and all the pressure that was coming through the public, and decided that they would introduce in 3 new clauses. The first clause regarding mandatory now, all right, so they moved away from...
the majority of the people.
Yes, who are the majority of the people. So they moved away from the voluntary, they now moved it into the mandatory space, and they said, people who've achieved the age of 45 and above are still employed, can get at least 20% of their money.
And Richard said no.
No, wait. The second was category is that if you've saved for at least 10 years, then you can get 20% of your savings, right? That is for those who are still employed. However, for those who have stopped working and have attained the age of 45, regardless of their situation. In fact, it said if you've stopped working for the last 3 years, so even if you get to the age of 45 and you'd lost your job 5 years ago, you would then qualify. Then you would qualify for 40% of your savings. The last category they introduced in was if you were disabled and you have stopped working for at least 1 year, then you are eligible to withdraw at least 75% of your savings. So those were the 4 additional conditions included within the law. What did that mean for the fund? I told you that when we started discussing this, I told you that the fund was worth 16 trillion shillings, or almost 16 trillion shillings. When we computed the numbers for those 4 categories of individuals or members, the figure that would came to about 6 trillion shillings if we consider their 20, 40, and 75%.
You need to pay out 6 trillion.
All right, we would need to pay out 6 trillion shillings right away. So what is the challenge with that? The challenge is that we pay money out of the fund from our cash. How do we get cash? We get it from 2 areas. 1, we get contributions, your normal contributions. 2, maturing instruments, maturing...
Where you have invested.
Where have you invested,
okay.
Right? Our equities don't mature because they are held until...
Long term.
Long term. Our real estate is not liquid.
It's not working well.
Right? So if you look at those 2 categories of assets, that is equal to about 4 trillion shillings. So of the 16 trillion shillings, let's say 4 trillion shillings is illiquid. We cannot get money out of it. So the only maturing part of your investment is your fixed income, really, if you think about it. And as I said, that is equivalent to about 11 trillion shillings of our fund. But now you want to withdraw 6 trillion. So that means that you will get half of your investment in fixed income, all to be paid out in a relatively short period. The other source of income, of cash flow, that is our collections. Our collections this year are estimated to be at 1.5 trillion shillings a year. But these come in not all at once. They come in over a period of 12 months. Okay? So if you are really looking at the money that you would need to pay out the 6 trillion shillings, you would need to either wait until you've collected the 1.5, but that would only be 1.5 trillion in a year to be able to pay those qualifying members. And secondly, you would now have to go back to your bonds and say, let me sell them. Now where the problems come. Because effectively you're looking at half of your bond portfolio to be sold onto the market. Let's bring back this into context. We hold about 40%, almost 50% at one time, of all government bonds. So basically we are going back to government and telling them, you know what? Our members want to be paid. We now need cash from you, so we want to discount these bonds.
They don't have it.
They might have it, but they would need to refinance this, as you remember they did last year. So most probably that wouldn't happen. So you would need to go into the market. We are the largest buyers of bonds, so we would now need to find somebody
bigger than you,
bigger than us, to buy it. And guess what? Those would probably be foreign investors, if at all, or even commercial banks. Okay? But even that, because we've now signaled to the market that we now need to change these, right? You remember the issue of supply and demand? Mm-hmm. Suddenly there's a huge supply of bonds in the market. That means that the price of these bonds will have to come down. And as you know, there's an inverse relationship between interest rates
and you wouldn't raise the amount of money
the price
that you
of
need.
Bonds. It would mean that the price, the price would go down of bonds that we're selling, but the interest rates would go up. Now, what does that do? It affects everybody, right? So the first thing that it would do, not only would it disrupt the fund, because we would have to do it at a loss, it would also disrupt the economy because it would lead to an increase in interest rates. Let's now go, assuming we've done that and we've given the money back to the members, right? Suddenly they've got a huge amount of cash, not a problem. What happens in a period when there is a huge amount of cash in the market, right? It's called inflation, because there's a lot of money now chasing. So suddenly you've got inflation pressures, you've got interest rates going up, and because now you need to institutional investors who have dollars to come into the market, they means that they will flood the market with dollars, which will now lead to a strengthening of the currency.
So in other words,
you've got a real disruption into the economy.
All right. You'd weaken the economy. You wouldn't get the money.
You would weaken the economy.
You'd sell them cheaply, and that was not workable.
It wasn't workable.
So it has since been, I think, revised.
So there was a lot of discussion, especially with the union, because they're the biggest stakeholders. We discussed eventually with the president, and the president saw that the original bill wouldn't work, and therefore the compromise that was reached eventually was, let us scale this down now to just one category. Individuals who have saved for at least 10 years, and those individuals who have reached the age of 45.
So you must have saved for 10 years, but that's not enough. You should also be over 40 and above.
Yes. So there is quite a number of people actually who are 45 and above, but have only saved for 6 years.
And they're not eligible.
Those wouldn't be.
So now, those who have saved for 10 years and are 40 and above, if 45. They are 45 and above, if really they appeared on your doorstep looking for the money, Richard, would you have it?
Okay, so that's a good question. The issue is that that number is now equivalent to about a trillion shillings. Okay? But that number includes people who are 50 and people who are 55. Okay?
Who anyway
who ordinarily
should be getting their money.
Would get their money. So if you are really strictly to look at the new risk that we've got of people to pay, that number of 1 trillion shillings reduces to about $500 billion shillings. $500 billion shillings.
$500 billion, okay.
Yeah. So I believe that with a little bit...
I think the proponents of this law now must be really smiling because of what they've just said.
Yes.
Because it's so possible that people under this kind of arrangement, they can get their money.
It's absolutely possible.
And it won't risk the economy, it won't risk the fund.
It will not risk the economy, it will not risk the fund. Of course, we've got to be careful because just for the numbers, last year we paid out almost 700 billion shillings, 632 billion shillings. This year we are planning to pay out 900 billion shillings.
Almost like a trillion.
Yes, almost a trillion shillings. So that would be in addition to the 500 billion.
So we'll be like 1.7, 1.4 trillion.
About that. So we would need to obviously manage our cash flow to do that. And one of the things that we've agreed with government is that once the law is passed, the Minister of Finance will then issue a statutory instrument to operationalize that clause. And what that means is that the operationalization of that instrument will depend on the cash flow that we've got, so that we are able to meet those payments in an orderly manner.
Richard Byarugaba, hold on to your point because you're going to take a break. When we come back, I just want to ask how, you know, the ordinary saver in NSSF, how much money do they have? And we also look into the proposition that money should be taxed at the time when the savers are getting their beneficiaries. What's your take on that? We'll be right back.
It was included in the initial law, and Parliament rejected it. So it's a clause that has been removed. But let me explain what it was, what the current situation is, and the difference between the two propositions. So will you permit me to do that? Mm-hmm. It's a little bit lengthy, it's a little bit technical, but I hope I can put it in simple language. Today, we have a taxing regime at the fund which is referred to as TTE, all right? Very important, TTE. What does that mean? It means that you, as Mr. Kamara, when you are contributing to the NSSF, mm-hmm. your income that you earn from NTV, that income of yours is taxed by the URA, yeah. And you pay a pay as you earn on the 5% you currently contribute to the NSSF. Because the other 10% is contributed by your employer. Yeah. That 10% that is contributed by the employer, it is an allowable expense. So NTV does not pay tax on it. So your employer is exempted. However, you are taxed on your income.
Or the payee.
On payee, all right? You get that? So that is the T. That's where the T comes from. The next T is the fund. When we receive your contribution, we invest it. When we invest it, we get an income or a revenue. That revenue
is taxed.
Mm-hmm. by the URA. So that is the second T. Now, when you reach the age of 55, Mr. Kamara, and you'd like to draw your money, the balance on your account is paid to you without any tax.
So well, I've already paid a lot of taxes anyway.
Yes, exactly. Because
you've paid when you're investing.
Yes, and yeah. So that regime is called TTE. What was being suggested in the original bill was an T. Right? What did that mean? It meant that you, Mr. Kamara,
you're exempted.
You would be exempted. Your income wouldn't be taxed at the time you contribute. NSSF would not pay tax on its investment income. However, because you have not paid tax at the beginning, you've not paid tax in the middle, you would pay tax when you're withdrawing your money. But you'd only pay tax if you are withdrawing your money at the age of 55. If you waited a little bit, 5 years, and you claimed your money at the age of 60, then you wouldn't pay any tax. What was the purpose of that? It was to change behavior. One, to allow people to save more money, because the more you save, the more tax-free, the more tax exemption you get, to allow NSSF to make more money, so that by the time Mr. Kamara comes to pick his money, there will be a huge balance on his account, and then URA would tax that if you get at the age.
I suppose that model works better for you.
No, not for me, not for me.
Because you're investing, and there's an E there.
Mr. Kamara, let me finish, and then you can ask. Sorry. So at the very end, you then pay tax on your payment at the age of 55. However, if you waited until 60,
take it free.
Take it free. Okay. So it was to help change behavior of people so that they can save longer and therefore not pay tax. Because if you are taking it at 60, then you don't do that. What was the implication of that? You can do financial models, you can do mathematical models. There is something called the power of compounding. The power of compounding means that if you have income and you do not take it out and you reinvest it, then you are investing on, you're compounding the interest. That means that by the time you exit the scheme, you would have a bigger tax liability to pay
on investments.
On investments.
Returns.
And then they would have now to wait for people to begin getting their money whenever they retire. Okay?
I can imagine without pay, there will be big trouble in the economy.
Yeah. So the money to be able to fill that big hole. So they decided to remove it out of there. So today, to my horror, I see this headline in the Monitor, which basically says, government to tax NSSF money. Almost like pouring, a dampener on
the 12.1%.
On the 12.15%. I was hoping that we'd have a big screaming headline. NSSF, just like you introduced it, NSSF did a great job and has, in spite of COVID, in spite of all the challenges of investment.
But you don't make laws. If the laws, I don't know why. You don't make laws, do you?
Oh, no, but
you don't.
But it affects me. I mean,
it affects you, but that's.
It's on my website. It's on my Twitter account.
You don't make laws.
It's on my Twitter feed. Everybody thinks now, this man knew all along that this law was there, and he was hoodwinking us.
But hoodwinking how? Because this is not it's not in your docket.
It isn't in my docket, but
then you shouldn't be screaming so loud.
I am the one who is, I'm the.
You're executing the whole thing.
Yes, I'm the one who. These are my customers, all right? And if my customers are not happy, I don't have a business.
So in your explanation, this one of those, that was one of the models they wanted.
Yeah.
That has not carried the day.
Yeah. So I would like to repeat it, on national TV to all our members and assure them that this story, as you probably have now realized, was because it was picked out of a memo that was written together with the law. But you know, at best, it is an error of commission rather than omission, and it's an error surely, which means that members should not be scared at all, because their money is safe. It will not be taxed. The current tax regime will continue. Members will continue to be taxed on their pay as you earn. The fund will continue to be taxed on its income, and the member will continue to get the amount in a lump sum without any tax being applied on the lump sum.
Okay, you're managing almost 16 trillion Uganda shillings. That's a lot of money. To many people, NSSF, and they put it, money is all that they have. The money, that's all the saving that we have. And when you look in the banks, commercial banks, the interest they're giving maybe 3 or 4%, I'm not very sure, but you're giving over and above what they could give. If I borrowed money in the bank today, maybe I'll need to pay more than 20% when I'm paying back. And I'm thinking, why can't NSSF formulate a certain method whereby you can lend the savers their own money to do business? After all, outside NSSF, the situation is bad, and this is all that they have. This is their last line of defense.
So, one of the good news about the amendments within the law, and I'm afraid that everybody, every time you talk about the NSF Amendment Act, they've looked at only one clause, that one clause on the midterm access. But there is so much that is in the bill. So, I think it's important for the public to understand that the bill had 3 main objectives. The first objective was to increase coverage. I'll tell you the numbers, you know. We have 19 million Ugandans. Only 2 million are registered under NSSF, all right? They are the ones who've saved or are eligible to save under NSSF. So what's happening to the 17 million adult Ugandans who are working? They're all mostly in the informal sector.
It's because the law is saying you don't have to have a company with 5 and above.
Absolutely.
So why don't you?
Yeah.
Why can't?
So the issue of
So somebody will have 4
Yeah.
and doesn't want to get the 5th because Richard will come knocking on the door.
So the good news is that the law is now going to be amended with this amendment to allow any company that has at least an individual to be able to register for NSSF. So that means that we can now register everybody who is running either their own business or is employing 1 or 2 people or 3 people, right? So hopefully that will increase coverage. More Ugandans will be covered. As I told you, many Ugandans don't have any form of cash saving apart from NSSF. So that's coverage. Coverage is so important. The second is adequacy, right? You asked the question before I went into the break, what does the average NSSF member have?
Yes.
It is a dismal amount, unfortunately.
Really?
Yes. It used to be around 5 million shillings. It has increased recently to about 15 million shillings. But it's not going up as much as I think it should. Let me give you another statistic.
So
Over
the
80
average saver
Yes.
in NSSF has how much money?
I told you, 15 million shillings.
15 million.
Yeah. But let me give you another number which probably will put it in more perspective. Less than 5% of our members have more than 50 million shillings. So there is 95% of our members have less than 50 million shillings.
So in other words, even midterm access may not help.
It will help those who have.
Because if
it will help those who have, but it won't help those who don't have.
Those have little.
Yes, absolutely.
You end up getting $1 million shilling.
Absolutely. So that is the sad part. So definitely. So one of the things that the law is suggesting is let us allow people to save over and above 15% that currently they are saving. That hopefully will help them to save a little bit more than they
And how do we save
currently.
15%? What do you mean? Because already when a company is putting 10% and I'm putting 5, so you want me to put 10 also?
Well, you can. The law now will allow you to put anything extra to the 15%.
Do you realize that first of all, when you take off payee and you take off local service tax, and then this mandatory whatever we're paying, which is anyway, that's my money. Sure. At the end of the day, somebody, you know, the money that you take home will actually be so true. Mr.
Kamara, next time invite me to talk a little bit about financial literacy, because I think that's what you need. But that's another day.
That's a challenge, right?
So anyway, at least there will be an opportunity for you to save.
For you, I would love to learn. It's a good thing to give, but for you, it's a good thing for you if you have more people saving more.
Yes, of course.
Yeah, it's a good thing.
But it's also a good thing for them.
But also,
it's a good thing for them.
Yeah, it's
don't forget that this is all about them. It's not about us. I mean, we don't take any pride in the fact that we are running 15, 16 trillion shillings. I mean, that's not a pride. Our target is get to 20, but that's not a pride. The pride is in Mr. Kamara has saved, Mr. Kamara has withdrawn his money, and Mr. Kamara has had a decent retirement, right? That's our joy.
Okay.
The third thing that it is going to do, right, which brings me to answer your question, because remember I started off answering the question, but giving a little bit of perspective, is we will be allowed to come up with products. And those products will be midterm products, short-term products. So things like medical insurance, things like education benefits, things like unemployment benefit. We know that unemployment benefit is a big deal, right? A lot of people lose their jobs and they don't have an income. So they will be able to save for a midterm product. But I think the most important one for me is for them to be able to get what I call a housing product. And how might that work? Two ways. One, either you get some of your money you've saved, take it to a bank and put it on a deposit so that you can then get a mortgage, all right? Or if you want your money to remain with NSSF because it's making a good return for you, leave the money there, but ask the bank to take an assignment of your money as a collateral. So once they know that you've got cash in the fund, they then give you a mortgage, which is at a good rate because the risk at which they are lending you has reduced substantially because you have a collateral, which is a cash, in-year cash collateral. And that way, you will be able to reduce the cost of the bank lending to you. And I think for me, that is the game changer. But we can't do that now because the law doesn't allow us. But the beauty is that with the new amendments within the Act, we will be able to come up with these products for our members to be able to help them to become, to use their money to make their lives better.
And there's one viewer who just sent a message here. He says, we applaud the good leadership at the fund. However, NSSF should venture into real estate and allow its members acquire affordable housing. It's time to act and stop storytelling. He says that is what Social Security is partly about.
Yes, it is. It is. And we are actually investing in housing. Unfortunately for us, our housing is still on the upper end, largely because of our inherent problem of land, right? If you look at land in Lubowa, where we've got, where we're building,
targeting the 5%, yet 95% of your people.
Yeah, absolutely. But land in Lubowa was acquired, donkey years, and it's part of our assets. Today, the land in Lubowa is about 600, 700 million shillings an acre. So you can't build a house on an acre or half an acre and sell it for less than 300 or 400, which is part of the land. You can't sell it for less than maybe another 300 or 400 million relating to the road that you do, the drainage, the electricity, and all the infrastructure. On top of that, you've got to put there the cost of the build. So the house, at the time the house comes out,
must all the houses be built around some of these places that Buziga, Lubowa, whatever? Why don't
you're absolutely right.
You could pick up another place.
We're building in Temangalo, right? Temangalo, we are building there 500, 600 houses. That we've already handed the site to a contractor. We already have a master plan which has been approved. We are waiting for the final approval from NEMA, and then we'll be off and running. And the houses definitely there will be affordable housing. It definitely.
Affordable is what?
Affordable is 200, maybe 300.
Million.
Yeah, absolutely.
And you know that majority of the savers in your fund save about 15 million.
Yeah, that's true.
So that is way above their scope.
Probably, yeah.
But maybe you can sell them so that you can make money off the houses to increase them.
So that they can get a big return. Yeah.
Okay, I get that. There are two scenarios: that the beneficiaries to be paid their benefit in a lump sum,
Yes.
or maybe
As an annuity.
as an annuity.
Yes.
What is better?
What's my take?
Yes. What's better? What's better?
That's a very controversial one. Again, research shows that almost 90% of our members, those who pick their money within the fund as a lump sum, within 2 years have spent it. It's gone, right? They've either put it in real estate, or they have started a new business that has gone belly up, or they have bought an asset which unfortunately is not earning any money for them. Things like a car, you know, a house or a plot of land, that sort of thing, which will not give you money. So one of the ways that we could improve on the time they take to keep this money is obviously turning it into an annuity. I think that with the new law, we will be able to offer that to members who are interested. I don't think it should be forced on people. I think that people should make that choice because, you know, everybody has their own way of dealing with things.
So currently, what is pertaining?
At the moment, you get all your money as a lump sum.
If I wanted to take an annuity?
You can take it out in bits and pieces, but a planned annuity is not yet available on the market. A planned annuity is actually a very technical instrument. It has to take into consideration things like inflation hedging. It has taken place things in place like adjustment to your salary and that sort of thing. So it would have to be offered by an insurance company. That's the sort of place that issues annuities. And unfortunately, because the market in town is not that big for annuities, I don't think there's any insurance company that can provide it. Although I know there are a couple of insurance companies, especially those that are branches of international insurance companies, they might be able to get that out of their own markets. But certainly the annuity market in this market is not available. So
is there any form of financial literacy you give to the people getting their retirement benefits? Because if you're saying maybe money is blown in 1 year or 2 years, then that's not a good thing because it's not serving the purpose. So how do you ensure as an MD of the fund so that people can actually benefit in their older age?
It's a shame you were not attending to my presentation yesterday. I had a slide which I am now looking at, which as you can see shows that one of our best programs that we did last year was our financial literacy program. The program is aligned to our purpose, and our purpose is making savings a way of life, okay? Last year we had over 67,000 participants in there.
Okay.
We've had 1,000 individuals who've graduated on the program. These individuals are now able to, they've gone through a formal program. It takes place once a week over a period of about 3 months. And they learn about entrepreneurship, they learn about personal investment options, they learn about things that help them to increase their income without necessarily going to do those things. For example, what they would call passive investment. So putting money in things like a bond, saving, or getting unit trusts from some of the providers in town. So a lot of that knowledge has been given to them. Okay. And we've seen amazing stories in there in our participants. So yes, okay, our program is all online. And we've had really roaring success during this period.
Richard, we're going to take a break. When we come back, I just want to know, why is the government supervising workers' money that are in the private sector? Is it even fair? We'll be right back.
Thank you.
Welcome back. You're watching On The Spot. My name is Patrick Amara. My guest tonight is Mr. Richard Byarugaba, who is the MD of NSSF. NSSF is supervised Minister of Gender, Minister of Finance, Who is your supervisor?
All right, that's been a little bit of a ride. So the law, the initial law says the ministry in charge of social security,
Which is gender.
which is gender. That's what was in the law. I believe after one of the scandals that we had around 2008, the president then issued an executive directive to transfer the supervision of NSSF from the Ministry of Gender, Labour and Social Development, and transferred it to the under the supervision of the Ministry of Finance, where we've been ever since. So up till today, we are supervised by the Ministry of Finance. And if you recall, one of the clauses that the president insisted on changing in the amendment was to ensure that in the law now, the Ministry of Finance is included in as the responsible ministry for.
But is that right? Because you have a ministry that is responsible for social security.
Yes.
And now social security, for which you are the MD, is supervised by the Ministry of Finance. Is it because of the money involved?
I think it's there are two things. One is the money involved, of course. The impact on the economy. I mean, I always look at the NSSF, and you really must visualize this. And a lot of people don't think about it. If you look at the world, global warming, you've always heard about this story that to demonstrate that there is global warming, the ice in Iceland, the ice in the northern pole, or the ice in the southern pole has been melting. It has been melting, and what is the impact of that? The impact of that is now the oceans become fuller, the winds change, the seasons change, the winters are longer, the summers are hotter, the winters are drier, and those sort of things. So because of that water going away, it basically has changed the world. NSSF is like that ice, all right? We trap a lot of savings for the economy, right, which would otherwise not have been used to invest, okay? Because, you know, a country that saves then is able to invest. I told you that today 40% of government financial bonds are actually subscribed to by NSSF. And that does something, you know. It works on the dams, it works on the bridges, it works on the infrastructure that the government is doing. So NSSF has a role in playing, in regulating, making sure that the economy is doing well, right? And we invest in the right companies, we invest in the right sectors, we invest in real estate, we create jobs and all those things. So it is important that an institution such as that, which has a huge impact on the financial sector, is supervised by the Ministry of Finance. However, having said that, gender still has a role. We have a board which is called a tripartite board, which has 3 constituencies. 1 is government, 2 is the workers, 3 is the employers, right? So the workers, through the unions, have 4 board members on our board. The employers have 2 board members, and government has 2 members represented by the Permanent Secretary, Minister of Finance, and the Permanent Secretary, Minister of Gender, Labour and Social Development. So that's where
that's where their voices.
That's where their voices come in, and that's where they get involved in the policy, especially on the social side, because, you know, there's 2 sides of our business. You've got the demand side, which is largely about the fact that people have to subscribe to us, and you've got the supply side, where we are actually supplying money to the economy to be able to invest. So that demand side is where we come up with the benefits and programs that help our members to become better, and that's the area that social security is involved in. So the products that we do obviously are based on what the social policy says, and today, you know, coincidentally, I was giving a lecture to the members of Parliament, basically telling them that one of the ways of improving our social protection policy in situation in Uganda is actually ensuring that the NSSF has a bigger mandate. Of course, the other things like reforming the public pension scheme, like improving the, introducing a national health policy and scheme, and also improving the way that payments are made to, like old people, and also social assistance to them.
That assistance grant.
The more vulnerable people. So all those things are part of social security.
Unfortunately, what they've done is to put those who are eligible to get the money at the age of 80.
Yes, of course.
But Uganda's life expectancy in Uganda
is about 63.
So, but they want to give you money 13 years after you have died.
Well, I can't talk about that. I can't talk about that.
But, I know you can't.
But all I can talk about is that all that social policy, NSSF plays a big part, and that part is played by the Ministry of Gender.
I want to open the lines. I want to open the lines so that you two at home or wherever you are, you can be a part of this discussion. You're going to see the numbers on the screen. Please pick your phone and call us and tell us what you think about the NSSF money, the midterm access, and all that you've been hearing. Here he is, the MD NSSF. Perhaps you have a question, and this is your money. It's the time for you to be able to ask. But as they come in, money at NSSF, Richard, belongs to people working in private sector. Is it fair to have government employees manage or regulate money that belongs to the private sector? Okay. Couldn't we have gotten other people to manage this?
All right, so...
They also have their own pension to deal with.
Well, the pension scheme called NSSF is obviously a scheme held in trust on behalf of the members, okay? So government set it up by an act of parliament. It doesn't own it. They are not shares held by government. But certainly because they have created it, they literally guarantee it. So one of the clauses within the law that operates NSSF is that in spite or despite how NSSF performs, NSSF must pay its members at least 2.5 percentage points every single year. So if the fund were not able to make that sort of money on investment, or if we invested in something so horrible that we lost all the money, government would have to come up and obviously sort of help. And that's the reason, that's their responsibility.
Okay, let me try to get a caller online. I'm told we have some people who would want to ask some questions. I have a caller. Hello.
Yes, hello.
Yes, sir. What's your name? Where are you calling from? And please, what's your question or what's your comment?
This is David Musobozi.
Yes.
From Nkozi.
David Musobozi in Nkozi. Go right ahead, sir.
Yes, I'd like to ask the MD, why is NSSF currently investing a lot of our savings in corporate?
It's a pity we seem to have lost.
In corporate what?
Well, but at least you can go through where you invest the money, and so that he doesn't have to wonder why you're investing anywhere. So he gets to know. We have another caller. Let me take maybe 2 more calls, or 3. Hello.
Sorry, David, call.
Hello.
Yes, sir.
Yes, NTV. This is Justin Odiangole.
Yes. I didn't. Can you repeat your name, sir? I didn't hear it well.
Patrick, my name is Justin. Justin Odiangole. OJ. I'm your friend. You.
Okay.
Yeah, Patrick.
Yes, sir.
I have 2 questions.
Yes.
To MD. One.
Okay.
If I'm a volunteer contributor of NSSF.
Okay.
If I paid from July, and I go beyond a financial year, because I think you declare your interest in July, something, I don't know. But assuming I'm paying beyond 12 years, am I getting interest for the extra month that I've paid?
Okay.
Because I don't know, but are you getting me?
Yes, Richard has understood it even more, so he's going to respond.
Exactly.
All right. Thank you so
The
much.
other thing, can just allow me 1 minute?
Okay, sir.
Yeah. I just want one thing, Patrick. I want to thank Richard MD for what he has done to my life.
Okay.
He may not be knowing me, but some years back, He may remember that I met him in the Kabira Club.
Okay.
During when MD, there was a party of a managing director of SBI International. It happened that I sat next to Richard, whom I'm seeing right now on the screen.
Okay, I don't know what he's headed now.
He told me much about contributing. I said, me, I'm a private sector. Then he told me, no, that's what we call a scheme, what we call volunteer contribution.
Okay.
Let me tell you, I'm so happy in my life for what this man did to me.
Okay.
I decided he sent somebody called Justin. I'm also Justin, but I'm a man anyway. To teach me about volunteer contribution.
Okay.
Patrick, as I talk now, I'm among the 5% whom we have been talking.
Oh, the 5%.
In fact, I could even be among the 3% or 2%.
Okay.
You know, he told me everything. He even showed me how much he himself he has done. You know, Richard, I'm so grateful. I feel you give me time one day to come and thank you in your office.
All right.
Thank you.
This is one grateful man.
This is brilliant. I love this.
That networking in Kabira really worked.
Absolutely. Yeah.
Okay.
Well, it's nice.
Let me just speak two more, maybe.
Yes, yes.
I have a call online. Hello. Hello.
Hello, how are you?
I'm fine, thank you, sir. What's your name? Where are you calling from? I'm afraid the line is not good, sir. Apologies, because we can't hear you. It is breaking. That's not good. So maybe let me pick another caller. Hello. Hello.
Yes, hello, Patrick.
Yes. What's your name and where are you calling from?
Yes, my name is Virungi Chris.
Chris.
I'm calling from Port Porter.
Chris, you're on air.
Yes, I wanted to inquire from Richard. In the annuity plan that you're talking about, I wish Richard talked a little more about it. Is there a possibility of, say for example, if I have 300 million with NSSF, I reach retirement, I qualify for the lump sum, can I be taking that the interest bit of that money?
Yes.
And I leave the principal.
Yes.
For example, can I say maybe I qualify for 50 million a year in terms of interest? So give me 5 million per month until such a time when I want all my money. Yeah. Is that part of the arrangement?
Okay, Chris. Richard will be responding to you and to your question. And let me take maybe two more if there is those who want to ask questions. Then the number is on your screen. You pick your phone and call us and tell us. Please be brief if you can. I have a call online. Hello.
Okay. Hello.
Hello?
Yes, hello, please.
What's your name, sir?
How are you, sir?
I'm fine.
My name is Kizito.
Kizito, where are you
calling in. I'm calling in from Zambia.
Okay.
My name is Kizito. I wanted to know. Yes, I have two questions. Number one, the issue of the new bill that is being brought online. I want to know from Richard, what is the economic impact of it? Because now businesses are going to incur extra costs. Because initially businesses have been registering 4 people, less than 5. But now you're bringing on board. So what is that impact? And the business is going to feel more pressure on that. And then on the issue of liberalization of the sector, would you be an advocate to encourage the private players to come into that sector? Because then there would be more competition and the banks would also be able to offer the same product but at higher returns to the people.
Okay. Thank you so much. I think I understand quite a number of people would want to ask questions, but I know you have some interest in this as well, so many of us have. Maybe let me also, there's another gentleman who's saying Byarugaba is one of the finest. Ask him, products are limited and the players have been shut out. Money bails out government in distress, contributors need housing, the fund behaves like a bank. What reforms in pipeline to make them independent? Okay. So
all right. So that's quite a little bit. So first of all, I'd like to start off with the Justin. Unfortunately, David, I didn't catch the question, but he was asking about why we're investing in corporate something. I don't even know. Maybe he meant corporate social responsibility. That's not actually true.
I think it was meant in corporate companies like maybe Umeme or whatever.
Yeah.
That's how we perceive it.
I mean, I mentioned that equities last year turned the largest return for us.
And that's why you were there.
That's why we are there.
Okay.
In fact, the stock exchange in Kenya, for example, grew by about 26%. That in Tanzania grew by about 5%.
Oh, you bought shares in Safaricom and...
Yeah, Safaricom, East African Breweries, KCB, Equity Bank, some of the cement companies. We've got shares in Vodafone. We've got shares in CRDB Bank in Tanzania, NM Bank in Tanzania. So, we've got quite a large portfolio of companies who are listed on the stock exchange. And
unfortunately, most of the companies, even here in Uganda, are not Ugandan. That's the funny part. I mean, the telecom is not ours.
Yeah.
The insurance is not ours.
Yeah.
Banking is not ours.
Yeah.
That's your story.
But we have invested, and when they make the money, our members get the profits. So in terms of return, I think your equity asset class is absolutely good, and the risks are minimized because this is in a controlled environment.
Okay.
All right, Justin had. First of all, thank you so much for the compliment. I'm glad you took up my advice, and I'm glad now you are part of the 5% that I talked about. You had a question on when we declare interest. We declare interest as we did yesterday or the day before yesterday, and interest is paid as at the 1st of July. Oh, sorry, the 30th of July. Which means the balance as at the 1st of July, which is the same thing. It's only one day difference. But that's when we declare interest. So all the monies that were in your account as at the 1st of July of the previous year is what we calculate interest on. So depending on where that balance was is where we calculate. So if you look at the law, it's very, very specific. It is 1 year behind. So for example, the money that is on your account today as at the end of June this year, is the money that is going to be used to calculate your balance next year. So the balance we are using for calculating the interest we paid out yesterday is the balance that was on your account on the 30th of July of the previous year. So that's how interest is calculated. The gentleman from Fort Portal, Chris, again, the annuity plan is something we have on plan. Currently, what we have is what we call partial payments. So, like the example you gave of 300 million shillings, if you qualified for it, you could come and pick out 100 million and leave us with 200 million, and then 200 million would continue to earn interest, and then every so often you could come back for your balance through what we call the partial payment. Of course, once we are allowed to innovate and come up with new products, then one of the products we are hoping to come up with is the annuity plan, where you will be getting payments again out of your balance, but on a programmed basis and with all the safeguards that are always available in an annuity plan. Initially, we might not be able to provide this ourselves, and we might need to utilize the services of an insurance company to outsource that product. But once we build enough basis, then we will be able to get this plan on our books.
Okay.
Mr. Kizito from Nsambia did mention about the new bill, the economic impact. We think that the impact will initially be a little bit tough, because obviously what it means is that there will be now new employers who will need to make contributions when they were not in the past. So it might put a pressure on them, but guess what? That pressure is the 10% that you'll contribute. The 5% is his part of his salary. So today you're still paying a salary, and therefore that individual will just get 5% of his money and put it in a savings account, and then you will have to top it up with 10%. So the impact would be that 10% and how many companies are involved. But as I've already said, we would have to take it easy to make sure that we don't hurt, especially during this tough period.
Meaning what, taking it easy?
Well, taking it easy and asking maybe people to to comply with time, give people payment plans, just like we did during the COVID period. We asked people to defer their payments over a period so that it could be accommodated within their cash flow, especially where companies were constrained in their cash flows. So again, it's something that we can deal with. If people are hurting, you can't go and begin forcing them to make contributions because it's a new thing. Liberalization of the sector. I am a big proponent of liberalization. I have always said that, and I've always said that if the economy, if the sector was liberalized, NSSF would still shine because I know that my colleagues and I have talked about this. If you look at our tagline, if you look at our vision is to be the social security provider of choice. So even in our vision, we envisage that there would be choice. In fact, we know there is choice today, because if somebody doesn't save with NSSF, they will still save. Where do they save? They'll save in land. They might buy a building, they might buy lusuku, they might buy goats, they might buy pigs, they might kulunda nkoko, that sort of thing. Okay. So that is choice for them, right? They're doing that for their retirement. So we know that although we are mandated, we don't have that monopoly because there is other pieces of choice for people to save. So liberalization would have been good, but government decided that they didn't want to liberalize the pension sector because there have been very bad examples of liberalization. One example that everybody talks about is Chile. Chile, a couple of decades ago, maybe 2-3 decades ago, actually 2 decades ago, under the bandwagon of liberalization, actually liberalized the pension sector. But what ended up happening? The costs of providing business went up. The losses increased. There was a lot of competition. Money was being spent on advertising rather than giving members interest. Their returns went down, and some of the funds actually went belly up. Okay. So government had actually to take back some of those funds in order to save that industry from doing so. Liberalization of the pension sector. Pension is a very, very dear thing. You cannot allow people who are in the private sector, who have a profit motive, to take the money out of the pension sector, because that will impact on the returns. It will increase the risk, and there is always that danger that people will never get their pension. And pension is, as I said, the last buck that anybody relies on.
Okay.
I think your friend asked something about products, and I think I've talked about products.
Yeah, you did. Okay.
We are going to come up with products, and just give us that bill. If you're a member of Parliament listening in, make sure this bill comes through, and we will be able to deliver to our citizens. And I can tell you,
understand there are so many people who would want to ask questions, but it's a question of time. So it's not that I don't want you to ask questions or to give your comments, but then we have to stop at one point. I know you've been at the helm as MD for NSSF almost 10 years now, if my recollection is right, and you must have had some hurdles. I remember the 2013 hurdle.
2013 hurdle. Oh yeah, I like to tell this story. So my contract was coming to an end. I had a 3-year contract. I had been hired in August of 2010, and 2013 August my contract was coming up for renewal. About a week or 2 before the contract came up for renewal, which the board had recommended to the minister, the minister wrote a letter to say all jobs, including that of the managing director, have to be advertised and competed for.
That's the Minister of Finance? That's
the Minister of my Finance, my boss.
Around the time that should have been Honorable Kiwanuka, right?
Honorable Maria Chonka, yeah.
Okay.
So, yeah, that caught me by surprise. I wasn't expecting that.
Richard, you were fired?
So, actually, I wasn't fired, but my contract expired and it wasn't renewed. So, yes, I was fired, actually. Let's be honest about it. So, anyway, I then handed over the office and waited on the interviews. The job was then interviewed. It was then advertised. I then did an interview, and lo and behold, I was the third of all the people who did the interview. And my board advised the minister that these are the people who, the first person who needs to be employed is this one. He's been the best in the interviews. And yeah, so I gave up. I had to look for another job. I was hired, lucky, by Vodafone. Vodafone had just set up here, or they wanted to set up here. They wanted a CEO, and they offered me the job of, I was Vodafone CEO for about 4 or 5 months. So one day, I think it was in October, I was attending a funeral mass at Christ the King funeral mass, and my phone is going crazy. And I'm wondering why. You know, I had left the office. I told them I was going for a funeral mass for my cousin. Why would my phone be going crazy? So anyway, after the mass, as I was going out, another phone rang, and it turned out to be a journalist, and the journalist was saying, congratulations. So what are your comments? I said, what do you mean, what are my comments? He says, well, haven't you heard? I said, no. He says, well, you are the MD of NSSF. I said, no, that was a couple of months ago. I'm not the MD of NSSF. So he says, but we've been told you are the MD. Anyway, to cut the long story short, a letter was waiting for me at the ministry, and there I was, 9 months.
Return of Rich.
I was back.
Rich returns.
So, yeah, so in November, end of November, I handed in my resignation at Vodafone. And December 1, I
went back home.
I took back my job.
Okay.
Since 2014, and I've been there ever since.
That was a roller coaster.
A roller coaster, yeah. It was. It was. Yeah. A big emotion.
But 10 years, we have seen growth and growth and growth, and with some kind of testimonies like people from Justin.
Absolutely.
I must say, Richard, you've done a good job, I suppose, because that's what people are saying.
Yeah.
And that's what you gave us yesterday, the 12% increment, and at one point you even hit 15%.
Yes, we did hit 15%.
So, and after all, even people are about to access their midterm.
Absolutely.
Which was
so we've given them everything. We've given them their money. We've given them a good return. We've given them convenience. We're one of the, in terms of access, we are one of the best. 6% of our customers access us by branch. 94% access us by electronic channel. Okay. You don't need to come into our branches. Okay. We have one of the best self-service. You can register online. You can self-serve on benefits. You can register as a company online. You can make contributions online. So the whole issue around automation, the whole issue around use of artificial intelligence, the issue of machine learning, one of our biggest problems at the fund used to be data, right? We would get a contribution from NTV for Mr. Kamara, and they had only said Mr. K, without specifying who Kamara was. And it would be so difficult to actually say this is Kamara and this is his money. So we had a lot of money which was not going into people's accounts but staying in a suspense account. I remember when I joined the fund, that figure was in excess of 100 billion. On a fund, that was about 10% of the fund was actually in suspense account, right? Today that figure is less than 20 billion shillings, actually about 18 billion shillings, and that figure has been coming down, but largely being resolved because of machine learning. Things like, I was asked at one stage, or I did ask at one stage, how long will it take us to clean our database? And they said, with 200 staff that we have in this section, it will take us 27 years. I said, oh my God, that's incredible. Today, our data index, which is the quality of data, is over 85%, right? Okay. Which means our data is 85% clean. Next month, meaning November, we've got a cut over into a new system, and our data is absolutely clean, ready to be transferred into our new system. I'm not worried about suspense anymore. And we've been able to do that through a lot of the new technology that's available of identifying people. So I don't need to know that it's Mr. Kamara, because there are things that you leave in your account that I'll be able to use machine will be able to use to identify that actually this money belongs to you. Thank you so much. What's going to be your parting shot? Well, my parting shot is that the fund has done really well over the last couple of years. We are committed to even improving. I believe that the short for us has been that our business has been growing, did grow quite rapidly and has beginning to slow down, all right? To give you an insight, we only grew by 700 billion shillings on contributions, right? Because we got in 1.3 trillion and we paid out 700, right? So we only grew by about 700 billion. The growth came from the growth of almost 1.6 trillion came from revenue that we actually got in. So our business model in terms of growth is beginning to scale down, and we think that the Amendment Act which will which will allow us to open up the market into the informal sector, to be able to open up the market to voluntary contributions, is going to be a big game changer.
Okay.
And we know that we'll be able to attack it because we have the technology, we have the way of being able to deliver the services, and our customers will get the experience with all the products that we're coming up with. So please come and join the NSSF, because it's the only place where you will be able to save and have a better life.
Mr. Richard Byarugaba, a man with the gift of the gab, committed to serve you. I suppose what he has told us, our money is safe. It's not only safe, but your money is working for you. Good night and God bless Uganda.